at its best moment, this current rebound, let's call it, we had, I would say it's November 30th. And there might be some month-end stuff involved here, but we saw 64% of the S&P 500's components back above a 200-day moving average. And granted, many of these moving averages are downward sloping, but still, you had about two-thirds of the S&P back in some semblance of a bull market. And that looked pretty good, and we've backed off of that a bit somewhat in the last 10 days. But if we can challenge that level in the internals, while at the same time holding above that 4,000 level, psychologically important 4,000 level in the S&P, and the three biggies next week, retail sales Thursday, the day before that FOMC, and the day before that CPI. Like if we could just get through those and we get that kind of bread thrust in the internals, we could rip into the end of the year. And I'm going to tell you, Mike, you and I, we could sit for an hour back and forth, all of the negatives. They're very well known. The AAII survey has had 36 weeks in a row where more people responded bearishly than bullishly. That is a longer count by weeks than COVID, which was 34 weeks, and the Great Financial Crisis, which was 15 weeks. 36 weeks of outright bearishness. We all get it. We all get it. But if we can clear through these three big bad announcements next week and the breadth is there, what are you going to say? It's going to be really hard to say anything much other than, all right, I better buy some more stuff. And look, it's seasonally, that's on your side. It's not easy to do if you're worried about earnings and inflation and all these things, but that's what the market is telling me.
Yeah, and you're saying if, and I realize you have to say if, because obviously there's no way to handicap it ahead of time, and these things can, even if it's a 60-40 bet that it's going to be for the better, you can't necessarily be that confident about it. But to your point about expectations, I mean, whatever this market's issues, excessive optimism is not one of them, right? I mean, you see strategists projecting in aggregate consensus next year for no upside to the market, and virtually everybody says down first, then up if we go flat. I guess that's a help. And how about the other stuff we're worried about? Wage growth too high. And it's a very tricky moment when we're talking about, we're now worried about risks to growth, but on the other hand, the economy hasn't slowed down enough yet.
You know what's funny? We really didn't fall apart after that strong employment report. It wasn't it wasn't showing any kind of abatement in inflation. It was just like showing resilience. And that didn't kill stocks. So I don't know that we're like outright rooting for a crashing economy and that sort of thing automatically puts a bid in for equities. I'm not so sure. But look, the TD Ameritrade keeps this thing called the Investor Movement Index. That is at its lowest sentiment since April 2020. Do you know what the nation's mood was in April 2020? The types of things we were contemplating? Millions of people about to die? Kids out of school? Like that is where sentiment is. So it's not going to take much. The put-to-call ratio this week hit a century high. So yes, I get it. All the negatives and high wages. All right, I understand. Who doesn't know about these things? So that, to me, that's where the setup is. And I'm trying for the first time this year to be in the bull camp. I'm struggling, but it's getting easier because nobody else seems to want to.
Right. Well, it is tough because I can think back to these relentless bull market years where you say to yourself, well, can it be that easy to just buy every 5% dip? Can it be that easy to just bid for every 20-day low in the S&P? You know what I mean? You know how it is.
And it was.
So, in other words, these trends can trend. Right. So, I guess the point is, in practical terms or in tactical terms, what specifically would you be looking to do just to sort of make sure that you don't have too little exposure to the market or look for stuff that the market has already punished or how to play it?
Well, on a tactical level, some of our index bets triggered long at the end of November. So those are on various time frames, and we don't look at daily. We don't look at weekly. We're looking at monthly moving averages and closes below, above. We're looking at slope. So we are longer now than we've been since April. And that may not last. This is rules-based. It's technical. We'll see what happens. But those are straight up index bets. It would really be a shame to get constructive or bullish on the market and then buy the wrong stock, like put a bet on a Meta or something that goes against you in a rising tide. Like even look at Tesla, which is a really big important stock now, versus this recent market recovery. It's going in the wrong direction. So I don't like. I think if you want to start to get more constructive here ahead of these big bad reports, maybe the right answer is to just not get too cute.